y'all. We're excited to be back. This is week number 14 and episode number 14 of the Building With Breven podcast. Once again, we're excited to be back with you guys, and especially me. I've been out for a couple of weeks and just happy to be back in the saddle, so to speak. So, we had a cool and fun episode for you guys last week with the guest, Steve Iltis, one of our preferred architects, and he had some great knowledge to share as far as designing custom homes, and provided a lot of knowledge and wisdom there in his 30 years of designing custom homes. So if you haven't listened to that episode, we definitely recommend going back and checking that one out. But today we've got a really exciting topic. We're going to be talking about what's on a lot of people's minds right now in the current economic state of the United States, at least. Rising mortgage rates, number one, building costs with what has happened to those, and we'll talk more in detail there. And then also we're going to talk about why it makes sense to build right now for a custom home. Now, I know this can sound like a custom home builder selling you guys on the fact that now is a good time to build a custom home, but we can assure you we're going to keep this as unbiased as possible. We're going to present data and make this very valuable episode for you guys to listen along to, and hope support our points to all the listeners out there. So anyways, happy to be here with Brian. We're back, and how's everything been?
For sure. And for those of you that are not numbers people or don't like data, we're going to keep this fairly simple, but obviously, as Steven said, don't want this to be that any biased opinion. We're just looking at facts and data and indexes and where things stand today. So there are absolutely a lot of fears in the market right now, and rightfully so, but there doesn't always have to be, right? And so there's always two sides to a coin, and we just want to inform our listeners of what we see out there today that's very factual.
Awesome. Yep, that's the goal. And I'm going to do some screen sharing so the people that are watching on video, that'll be a little bonus that you guys can follow along with. But even if you're in the car or listening just on the podcast, we'll do our best to talk through exactly what we're looking at and explain those numbers clearly so that we're presenting the full data to you guys. So, I think without further ado, let's jump into this episode and start by talking about mortgage rates. So, Brian, he actually has his loan officer. He is a loan officer, so he has his mortgage license, and I would like to hear more about that as we talk through these mortgage rates. But I'm sure you can hit us with historical data and all that good stuff, right, Brian?
You talk me up to more than I actually am. I technically have my loan originator's license in the state of Texas. However, I am not an active loan officer at the moment. So I do have my license, but not utilizing it. So slightly removed, but still look at obviously where mortgage rates are and where they're trending. And if any of our listeners ask or would like to ask, well, what do you think mortgage rates are going to do in the next 12 to 24 months? I will not answer your question because I will just be wrong. So that's I think you get that answer a lot from many people, economists, whoever you're talking to, that you might think they can see into the future, but they can't, just like you can. So, Stephen, if you want to share your screen, we can.
Yeah, I was going to say, are you trying to tell us you don't have a crystal ball?
I've never owned one, and nor will I ever, because it's probably just a waste of my money. So,
yep, absolutely. Well, cool. I will. We're opening this up. We're going to go ahead and start the screen share. And we'll start with the first graph that shows a history of mortgage rates and where they've come from since they started tracking them in the 1970s, early 1970s, 1971 to be specific, to current day, 2023. So Brian, can you see that on your end?
Yes, I can.
Yes, I
Thank you.
can. Thank
So
you. So
mortgage rates
mortgage
most closely correlate to or follow the 10-year Treasury note. So we don't have that data here to show you how it follows that in a positive correlation just for the sake of time. But really just wanted to show the historical 30-year mortgage rate trend and where it sits, as Stephen said, from 1971. So there is not an average on this chart here, but if you were to take an average across the last 40 plus years, I mean, we're in that, the average is in that 7-8% range. So I think the shock that people are feeling right now, the fear that people have of just saying, "Oh, I'm waiting for rates to come back down," are just because we have been feeling and enjoying rates being below historical average for the last 15 or so years, right? Consistently and well below that 7-8% average benchmark. So now that we have quickly, very rapidly seen interest rates and mortgage rates because of that rise so fast over the last 12 to 18 months, we're back near the historical average. So the takeaway from this is, while people are saying, "Hey, I may sit on the sidelines and I'm going to wait to build my custom home until rates come back down," the truth of it is, and the reality is, they may never come back down to 3%, 4% in our lifetimes. Again, I do not have that crystal ball. I'm not here to forecast or make a wild guess of what they're going to do in the future. However, we do have facts that the historical average is 7-8%, and we're back at that level. Now, one thing about mortgage rates is once you get into a mortgage, as long as you're comfortable at the rate that you lock into from a monthly cash flow perspective, if rates drop, you can always refinance. So don't want to get caught up in, "Oh, well, rates are high, I'm going to wait for them to drop." It's really just balancing where you are in your life with your monthly cash flow. Everybody has a budget, as we say quite often. It doesn't matter how much money you make. Everybody has a budget that they say, "Hey, I just don't want to, or I can't afford to spend more than this." So, Stephen, in a nutshell, that's what we're looking at here. It's just, we're feeling the pain from all the the low rates that we have just become accustomed to. We've been so comfortable with them because we've had significantly lower than average rates for such a long time that I do believe that when 7-8% is here for a longer or extended period of time, that it will just become the new normal. Right now, it's just too fresh in our minds of where we came from that people are saying, "Oh, this is just so expensive."
Yep. Very well said. Very well said. And yeah, for those listeners that are just listening and not watching this recording, just to talk through this graph a little bit, like Brian said, the mortgage rates were starting to track in 1971, so 52 years ago. They peaked in about 1981, 82, 83, the early 1980s, all the way up to a percentage rate of about 17 or 18, maybe even 19%. And then slowly trickled back down all the way to the all-time low that we saw mid-COVID crisis, that went down to about 2.75% was some of the lower rates that we were seeing. And like Brian said, I mean, that was so fresh just a couple of years ago that we've climbed so fast from that all-time low back to a historical average that, it's really shaken some people up and caused a ripple effect across the entire industry. But I think to sum all that up is that we are still at that historical average since they've been tracking these rates from 1971, which that average, like Brian mentioned, is right there around that 7.5 to 8% mortgage rate. So that's for a 30-year fixed, by the way, with competitive credit ratings and all that good stuff. So, Brian, too, the other thing that this reminds me of is an old adage that I've heard many times being in the industry, but people love to say, you marry your mortgage, but you date your mortgage rate, right? So marry the mortgage, date the rate. And I think what that means in a nutshell is that you're marrying the price that you're paying for a home, right? You can't change that once you've locked that in. Your mortgage rate, you can refinance at any point. If you want to refinance it 6 months, 6 years, whatever you want down the line when it makes the most sense. So, like you mentioned, I mean, nobody has that crystal ball, but if prices start to, or mortgage rates starts to decrease, then, that's something that people can capitalize on when that happens, or if it happens. So, yeah, I think a lot of good points there. Any final notes on mortgage rates before we move on to construction costs, Brian?
Really, just that it does seem very expensive right now, but it is all relative, right? And I've said this, and I'm going to say it probably more than once again before we wrap up, but it just comes down to your monthly cash flow, right? I mean, that's really what it is, and everybody has that budget. So yes, the interest rates rising, mortgage rates rising, whatever metric you're looking at, yes, it does absolutely impact affordability. I mean, there's no skirting around that. But I think that if the concern is, well, I'm not going to build until rates come back down, life is too short, and we don't want you to just say, "Hey, I spent my whole life waiting and not doing."
Yep. Well said. Awesome. Well, let's move on to our next graph that we've got here. This one is going to be the construction costs. What it is actually, for those that can't see the writing here or are not watching, it's the producer price index by commodity and its inputs to industries. So they've broken this down on net inputs to residential construction goods. So they take an average of lumber and drywall and other construction related goods for residential construction in particular. So Brian and I both realize, and we realize, that this is only one half of the puzzle, and labor provides the other half. But labor rates have tracked, I would imagine, the same way that this graph shows, and we've seen it firsthand that we have a shrinking labor base and labor pool, and there's not many people coming in to replace those labor jobs that are slowly dwindling. So, we can extrapolate from that labor prices are going up just as fast or even faster than the actual goods or materials that this graph is showing. So, anyways, we'll look at this one half of it and talk through our point that construction costs are on the rise as well, and always have been since this graph started in 1986. So we've got starting it in 1986 all the way through current. And for those of you that can't see it, there's gray bars here that mark out recessions that we've seen over those time periods. We can see what that's done as far as adjusting the costs of residential construction goods. So, Brian, you want to talk us through this graph a little bit more?
Absolutely. So the index is 100 in the middle of 1986. And what is interesting is that there are very few years or periods of time where the index has actually declined, even during the recessions that you note. So, well, let's jump right to the housing bubble and crash of 2008 to 10, 2008, 2009, 2010. The index at that point, at the peak, was in about 2009 was just under 200, meaning the residential construction goods was nearly double what it was. The 200 would be double, right? So nearly double what it was when this graph started back in 1986, right? But that was the peak. Obviously, we had the crash at that point, and what you notice is that the low point of this graph, the index, is 184. So the peak to the worst part of the housing crash in the 2008, 2009, 2010, the residential construction good producer price really only dropped about 5, 6, 7%, right? If you do the math from 193 to 184, it's about 5, 6%. So probably surprising to most of you. It was a bit surprising to me when I went and looked at this graph that the goods prices really did not drop like the the housing prices did, right? So if we fast forward, look a little bit closer to recent years, we had some ups and downs, but overall the graph continues to trend upward. We have COVID, which was early 2020, and we actually saw it does show there for about a month or two. Actually, probably one of the greatest drops in this graph since 1986, only for a period of about 2 or 3 months. And then everybody can guess, even if you're not looking at what happened after April, May of 2020. The line skyrocketed and actually increased at a greater rate than it ever has, thanks to, of course, inflation and the supply chain challenges that we have all dealt with for many, many years, really since 2020. And we've peaked out at about the middle of 2022 to a index of 322. So 322 meaning the residential construction goods costs are 3.2 times what they were back in 1986. So from there into today, we've actually seen them not really change. They've really flatlined. I mean, they've come down a slight bit, bounced back up, but overall, we're still near the peak of the cost of goods that go into building residential homes. So takeaway from this is that as much as people talk about or want to say, I'm going to wait for costs to come down, or lumber prices have come down, when you add it all up and you look at all of the goods that go into building a home, even as lumber has come down, there are other goods that are offsetting the savings in the commodity like lumber, right? And I know lumber is still a big portion of the goods that go into a home. There's so many others that add up to a big number as well. So if your thought process is, hey, I'm going to wait for costs to come down before I build a home, I'm fearful. I'm not fearful. I'm here to tell you that based off the last 30, 35 years, costs don't come down. So if you're going to wait, you're probably going to be waiting forever.
Yeah. And I think that's a fantastic summary of this graph. And one thing I want to note is where we saw the rapid increase in construction costs from early 2020 or mid 2020, right after COVID was identified as a thing, basically, and building costs went through the roof. One of the other reasons for that too that we have to keep in mind is, all politics aside, I mean, the amount of money that was pumped into the US economy at that time was probably a huge driver for not only construction costs increasing, but all costs. I mean, we've seen inflation across the board, and I would imagine inflation graphs and charts are showing something similar to this. Construction's not, in a world of its own. So, cost of everything went up, and that was the result of a lot of excess money pumped into the U.S. economy. So, that's one other explanation for that rapid increase. And now we are at a point where, like you said, Brian, I mean, it's stayed relatively stable since mid 2022 to now end of 2023. So where they'll go after this, once again, you and I both don't own a crystal ball. We have no idea. But we can extrapolate, and we can take the averages from the past 37 years of this graph. That average, what did we calculate, was 5.86%, I believe, year over year increase in construction costs. So, I think another takeaway there is that on the average, if you wait, I mean, construction prices are going to continue to go up at a average rate of 5.86%. So for easy numbers, let's just put that into perspective. You want to build $1 million home, construction costs, that's labor, materials, whatever else, That $1 million home today, on average, will cost you $1,060,000 next year, 1 year from today. So, every year you wait, you are just kicking the can down the road, and costs are going to continue to go up, and it's just one of those things. So, any final notes on this graph, Brian, before we move into our last point of finally wrapping all this up?
Nothing on this graph. I'd just like to mention the building cost index as well. It's not a graph to show, but it is uh, another index that we look at by ENR. They're another construction company that looks at economics, and they have very similar trend to this. The building cost index, which actually started in what they call the BCI, started in 1961, and it's actually gone up steadily, even during the crashes of 2007 to 2012, and some of the other ones prior to that as well. So, we do look at multiple data sources, what makes sense, what is conflicting, and I mean they are all telling the same picture, that costs just simply don't go down, right? If they do, they go down for a short period of time at a modest rate, probably not as much as some people would like if they're trying to time the market or time when to build their custom home.
Yep. Awesome. Yeah, good summary there. And yeah, ENR's got some good data as well. That looks at a little bit different pricing indexes than this PPI. Well, cool. Yeah, I think our last point, and just to kind of wrap this all up, is really going to be a simple one. But in the end, we want our homeowners to feel comfortable with the home that they're building, and we would recommend that to anybody listening to this, that you never want to push outside your comfort zone. And if rising interest rates or rising construction costs are going to do that, then it's not worth it's not worth pushing yourself to get into a home just because of this data that we've presented right now. Our purpose in presenting this data is to inform people that have the means to build the home or a very close home to what they want, but they are trying to time the market or trying to wait for interest rates or construction costs to come down. And we just don't want them to sit on the sideline for indefinitely and never get into that dream home that they actually truly want. Because like Brian said earlier in this podcast, life is just too short, right? It's not worth waiting and trying to play the short-term game when we'll pull up this picture right here, but the average home ownership in America is about 13.2 years. So think about the stock market, and the best way we can compare this is, if you're trying to guess where the stock market's going to be next year, probably very hard to do unless you have some insider knowledge or are a stock market expert or guru. That's the same thing with the real estate market. If you're only planning on living in a custom home that you're going to spend a lot of time designing and building and bringing to life for very short period of time, 1, 2, 3 years, I'll be the first one to say it doesn't make sense, right? If your goal is to not lose money on a home in that sense, then that's not the play. But like we look at, I mean, the average homeownership rate is 13.2 years for the typical American. So knowing that you're going to build your dream, most of the time forever home, or at least custom home, 13 years is a long time for the market to do what it's going to do. And on average, the real estate market appreciates just like the stock market does. So over a 13-year period, I think we can all point to the fact that it's probably going to be a positive gain and a positive experience, and you'll be sitting on a nice asset. So, yeah, I mean, what do you have to add there, Brian?
Yeah, I would just say that the 13.2 years of average median years of ownership is across, that source is actually Redfin. So that's across the entire country with all different types of homeowners, right? But in the custom home building world, you're probably going to exceed that 13 years, right? Because you're not going to build a custom home and have plans to leave 3, 4, 5, 10 years down the road, because it's a custom home. It's hopefully and ideally your dream home that, hey, this is where I plan to live the rest of my life, or at least for the next 20, 30 years until I move on to that next chapter. So like you said, Stephen, we can say it over and over again, very hard to time the market. Housing prices, we'll be the first ones to say it or agree with anybody who says it, that, housing prices do go up, they do go down. It's part of the market. But what we wanted to show you today were really the three data points being the where mortgage rates are, and that, hey, they're near historical averages. The costs, the true costs that go into building homes isn't going down, and most likely won't go down to any significant extent in the coming years. And that the length of home ownership is this long, that the market is going to do what it's going to do. Your house value is going to do what it's going to do. But like you said, Stephen, life is too short, that as long as you have the means to get into the home that you would like within the budget you're comfortable with and your monthly cash flow, now is not a bad time to begin construction, or to consider, hey, I'm ready to move forward with building my custom home, even with all the fear on the news and in the marketplace and you name it. The other point I want to make is I listened to a presentation from the president of ITR Economics. His name is Brian, and he talked about just macroeconomic trends and said anybody that says that the economy changes or stalls or waits because of an election year, they're wrong. So we are, at the time of this recording, we're at the end of coming up on the end of 2023. In October here, 2024 is an election year in the United States. And people, you hear all the time in the media, oh, well, we're going to wait and see what happens with the outcome of the election. The data shows and has shown for many, many decades that an election year is no different than any other year. It's all just hearsay. It's all just talk. So I put that out there as you start to look into 2024, because we're almost there, and people say, oh, there's a presidential election. Not coming from me, not my opinion. Someone that is an economics expert with ITR Economics says, hey, that election year has nothing to do with anything for the economy.
Yep. Yeah. It's a good point there. Another thing to think through too on this is that, just like the stock market, as hard as it is to do, the best time to invest is usually when there's maximum fear in the market, or uncertainty. Uncertainty and fear kind of go hand in hand in any market. But those are usually the best times to enter a market. And then whenever there's greed in the market, that's the time that people should be really fearful, because there's a lot of certainty, or people think there's a lot of certainty in the market, and that's what causes the greed. And then, you're working against the economy the entire time. But overall, historically speaking, buying and holding over the long term is always a good play. So like you've talked about, and like we've already hit on, if homeownership is a 13-year venture on average, then that's the long term, right? Holding a home that long is most often going to be a smart move over the long term and over averages. So that, and it takes me back to another saying that they say, the best time to plant a tree was 30 years ago. The second best time is today or now. I would argue the same thing with custom homes. Best time to build a custom home was before COVID, or 30 years ago, or 100 years ago, when prices were extremely low. Second best time is now, because we look back on this time 10 years in the future, or 20 or 30 years, we're going to be saying the same thing. So something to keep in mind. And hopefully this podcast has shed some light on statistics and data that people can plan around or use to feel more comfortable in their decision-making process on building a custom home at any time, whether it's now, peak fear in the market, or peak confidence in the market. It doesn't matter, but historically speaking, the best time to build a home is now. So, yeah. What do you think, Brian? I think that that probably wraps it up for this episode, unless you have any final parting thoughts.
That's all I've got, other than for those listeners that don't like data and numbers and we bored them this week, I can assure you next week we won't hit you with a bunch of economics data. We'll get into something else.
Yeah, no, good point. Yeah, this one is a little different than any podcast we've done so far, but hopefully it provides value to those that want to listen to it. So, yeah, I think a way we're going to wrap this up, Brian, is like we have on recent episodes, but to ask the listeners that please, if you found any value in this episode or any episode you've listened to of ours, please feel free to share it with friends, family, or go ahead and give us a rating or a review on whatever podcast platform you guys are listening on. It really helps us get this information out to more people and ultimately accomplish our goal of helping people in the process of custom home building. So, yeah, thank you everybody for listening and taking time out of your precious day to spend with us and give us 30 minutes of your time. We're always grateful of it. And we'll catch you guys on the next episode.